Hi, it's Jeffrey Cohen, Chicago Quantum, U.S. Advanced Computing Infrastructures Incorporated. I'm the President, Investment Advisor Representative out of Illinois. We're here to talk about our new stock service called the Platykurtic Stock Service. You get this when you become a client. So, first off, what is a platykurtic stock and why do I care? So, platykurtic stock distribution has more daily stock price changes around the mean or expected value of the returns, and it has fewer outliers. Platykurtic means flat tail, so you can think of a distribution without outliers, without very many outliers. And so that's great. That means you're more likely to end up kind of where you expect in the frequency distribution. So it means in regular language that the returns of a stock that is platykurtic, it's more likely to have your return or your result in the day where you expect it and less of a chance of surprise. More expected returns within 2 standard deviations of the mean. We narrow our list to also include stocks with low variance of daily stock price changes. So the stocks have a lower variance than a diversified portfolio of all the stocks analyzed. So why do we do that? So you get more of a taste or a flavor of the platykurtic stocks, the ones that don't have outliers. Because if it's low variance and it's also platykurtic, you might think it is a super safe stock, which it could be. But it also might be a stock that has a chance to trade on it, right? A unique trading opportunity, both in trading the stock and the stock options. And our leptokurtic stocks are low variance, and so now our platykurtic stocks are also low variance. To show you like a stylized view, if you can imagine a bell-shaped curve, this mushroom is perfect because it is a lot flatter than a typical normal bell-shaped curve, and there's no tail at all. You can see how it just comes to an end. And so I'm also going to show you a uniform probability distribution, a continuous uniform distribution. And you can see here that from A to B for this particular random number, there's no chance of getting anything outside the expected range of A to B. So that could be like rolling a 6-sided dice. It could be like flipping a coin, right? You expect all the results kind of in that expected range. And that's interesting because a normally distributed stock has more outliers than a platykurtic stock. And so I'll walk through in a minute what we talk about on our webpage. I made a meme. Here's a guy shocked, platykurtic stocks, fewer surprises, right? And then I'll show you the data that we've gathered from today's run last night, but I'm also going to show you what we publish in our website so you can see it. So we actually just changed it. So we are showing you platykurtic stocks that have a standard kurtosis score of less than or equal to 1.5. Now, in fact, we have adjusted our platykurtic limit to 1.1. And we did that because we were getting too many stocks. And so we decided 1.1 for right now. It's subject to change, right? And so now the stock is going to be platykurtic 1.1 or somewhere around that, and a variance that is less than or equal to the total population in the run. Platykurtic but low variance. I realize that whole top, nobody really cares about what I used to do. They probably just care about what I'm doing right now. So we share it every single day. When you buy a run, you get U.S. listed stocks either that are profitable, that make money, that are up stocks, or that lose money and that are down stocks with a platyk distribution and a low variance. And then I talk a little bit about that. So, and then what are the expectations? What are the trading implications? Investors may expect a normal distribution of stock prices. They think that stocks go up and down seemingly randomly with new random information. But with a stock with a platykurtic distribution, you've got more of a grouping of actual price changes that are in the range. there's a smaller chance that you're going to see an outlier. Think of them as the tails are pushed flat onto the x-axis so that they're very thin tails. And so, however you want to do it, I think that's great. And by the way, we believe that you may have a chance to sell options or covered options and have less of a chance of making that big payout from any one large daily move. So the idea would be for platykurtic stocks, you have a less chance of having to pay out. It's our hypothesis. No trading strategy is foolproof. Do your due diligence, be really careful, all that good stuff. So what we do is for the companies that make a profit, we give you the platykurtic, the basically standard kurtosis score, which for ADC is a 0.44, well below our 1.1. And the variance is 2.04 times 10 to the negative 4, which is a little bit below the variance of the total distribution. And so the variance of the S&P 500 is 2.3 times 10 to the negative 4. The distribution for all the profitable stocks is 2.6 times 10 to the negative 4, or about 13% higher than the S&P 500. And in this case, you see it's 2.03, so it would be a solid 20% smaller variance than all the profitable stocks we follow. And that kurtosis score, that standard kurtosis score against a 3 is really small with a 0.44. And then there's others. What could be interesting? CME, which is the Chicago Mercantile Exchange, 0.977 kurtosis score, so right around the 1.1. And the variance is 2.50, so it's very close to the variance of the population. So, yeah, it's a little less platykurtic and a little less low variance, but it's interesting. The other thing I find fascinating is the S&P 500 itself. It, of course, has a 2.3 times 10 to the negative 4 variance, because I told you that already. But it's got a kurtosis score of 0.33. So you're not going to get as many surprises with the S&P 500, and that's probably because it is a capitalization-weighted index, and things move around and they offset each other. It is rare that the entire market rises or falls to such an extreme. The S&P 500 is like a little bit of a buffer. It's a little more centralized. That's a reason why people use it as an investment vehicle. So there's your test that what we're saying makes sense. For your negative net income companies, we just give you the stocks themselves. You can follow up. SPY shows up in both because it's an index we add into the run, and so it's not actually a stock of a company. And you see CEQP, right? Crestwood Equity Partners, Pipeline Company, LNG, liquid natural gas. Utz is a food company around Chicago. All right. So you're seeing companies like that. And if I were to look at what I saw here, so the down run after we tighten things up a bit, platykurtic and low variance. See if I can blow this up so make it so you can see it nicely. Here we go. ALTR, AY, BEP, Bio. I don't know a lot of these stocks. They don't move. D&B, I think, is Dun & Bradstreet. EQH is Equity Holdings. It's another, like a pipeline company. I don't know a lot of them. So these are not stocks that come onto the radar screen, which is interesting. We also have our leptokurtic stocks. So what's interesting now is we've adjusted, so it's a 1.1, to have 21 platykurtic and 20 leptokurtic. So now let's take a look at the uprun. I'll move it over here. Search on platykurtic. So here you go. There's a lot of these stocks. So the leptokurtic has 17, Platykurtic has 53. So there are more safe stocks than there are leptokurtic kind of interesting risky stocks. UNH, I believe, is actually I'm not 100% sure. WRB, I think it's Warner Brothers Records. WM, Waste, I don't know who these are exactly. Yum Brands, I know. Yum Brands is Taco Bell. So Southern Company, MET is MetLife. EQC is it's a pipeline company. Again, you're not going to know a lot of these stuff. AFL is a financial services. I want to say that might be Aflac, which doesn't really trade, just has a cute duck. FE was another one you could barely heard of. HE, not a very well traded stock. So MCK, McCormick Spice Company. I mean, that's what you got here, right? And so you might look at these safety stocks. You might also try to find some with a dividend, pay a nice dividend, low variance, low chance of a surprise. And so it's interesting. You might want to know who those are. Those might be interesting to invest in. And we offer that as part of our service, as part of our run. And so that is called our Platykurtic stock service. And you get that when you buy a run. Thank you very much for watching. I'm Jeffrey Cohen. We are U.S. Advanced Computing Infrastructures, Inc. We're an Illinois registered investment advisor. We're also a consulting firm. And you can find out more about us at chicagoquantum.com. And if you go to the main page and you scroll down, you can see our brochure. Thank you very much. Take care.